The rise of the Genius Act, key strategies behind the US dollar stablecoins challenge to global currency norms. Introduction. On July 18, 2025, the United States marked a significant regulatory milestone with the signing of the Guiding and Establishing National Innovation for U.S. Stablecoins Act Genius Act. This comprehensive legislation establishes a federal framework for the issuance of payment stablecoins, digital assets aimed at maintaining a stable value relative to a national currency, typically the U.S. dollar. The Genius Act passed with notable bipartisan support, reflecting a broad consensus on the need for a structured approach to digital currencies that would ensure consumer protection and bolster financial stability. Overview of the Genius Act. The Genius Act introduces a robust regulatory framework for payment stablecoins which have seen explosive growth, processing approximately $33 trillion in transaction volume over the past year, far exceeding traditional payment methods. This legislation is designed to address the complexities associated with stablecoins, ensuring they are underpinned by high-quality reserves while integrating anti-money laundering (AML) protocols and enhancing consumer protections. Key provisions of the Genius Act. 1. Regulatory framework. The Act mandates that payment stablecoins in the U.S. can only be issued by permitted payment stablecoin issuers. These issuers must be U.S.-based, maintain reserves on a 1:1 basis with their outstanding stablecoins, and be subject to rigorous regulatory oversight. 2. Consumer protection and financial stability. The Genius Act emphasizes backing stablecoins with low-risk assets like cash and U.S. Treasuries, requiring regular disclosures about reserve holdings to reassure consumers and promote market stability. 3. Anti-money laundering compliance. Both domestic and foreign issuers are required to comply with AML regulations, which levels the playing field and mitigates risks associated with illicit financial activities. 4. The dual regulatory pathways. The Act allows for both federal and state regulatory frameworks, enabling state-level issuers to receive approval from the newly established Stablecoin Certification Review Committee (SCRC). This dual approach aims to prevent regulatory arbitrage while promoting innovation. 5. Market impact and future prospects. The Genius Act positions the U.S. dollar stablecoins as crucial players in the global economy. Analysts predict significant growth in stablecoin holdings in U.S. Treasuries, potentially reaching $3.7 trillion by 2030, reinforcing the dollar's status as the world's reserve currency. Legislative journey. June 17, 2025, the U.S. Senate passes the Genius Act with a vote of 68 to 30. July 17, 2025, the House of Representatives approves the Act with a vote of 308 to 122. July 18, 2025, the President signs the Genius Act into law. Implications of the Genius Act. Enhancing consumer confidence. A central tenet of the Genius Act is the enhancement of consumer confidence in stablecoins. By ensuring that stablecoins are backed by high-quality reserve assets and requiring transparency through regular disclosures, the Act seeks to protect consumers from potential risks associated with unstable backing and lack of information. Financial market stability. With stablecoins processing trillions of dollars in transactions, the Genius Act aims to prevent financial instability. By mandating that stablecoins are backed by low-risk assets, the legislation minimizes the chance of a collapse similar to a bank run, where a sudden loss of confidence leads to mass redemptions and instability in the financial markets. Equal regulatory standards for foreign issuers. Another important aspect of the Genius Act is the requirement that foreign payment stablecoin issuers comply with the same regulatory standards as U.S. issuers. This provision is crucial to preventing foreign entities from exploiting regulatory gaps, ensuring that all stablecoin activity in the U.S. adheres to rigorous AML and sanctions requirements. Regulatory clarity. The Genius Act provides a clear framework for stablecoins, which is expected to promote innovation within the digital asset space. By delineating pathways for both federal and state regulation, the legislation offers a coherent structure that could encourage more entities to enter the stablecoin market. fostering competition and innovation. Future prospects. Transformation of payment systems. The introduction of the Genius Act is expected to transform the payment systems landscape, and the U.S. major corporations like Amazon and Walmart are already exploring their own stablecoins, indicating a shift toward mainstream adoption. The potential for stablecoins to streamline payment processes, reduce transaction costs, and enable faster settlements is likely to drive further integration into everyday commerce. Potential market growth. As stablecoin adoption increases, analysts predict a scenario where stablecoin holdings in U.S. Treasuries could significantly impact the Treasury market itself. The potential for stablecoins to become a dominant form of digital currency raises questions about the future structure of monetary policy and financial systems globally. Global regulatory considerations. The passage of the Genius Act places the U.S. at the forefront of stablecoin regulation, prompting global discussions around the role of stablecoins in the financial ecosystem. Institutions like the Financial Stability Board (FSB) have identified stablecoins as a key area for regulatory scrutiny, indicating that the global financial community is recognizing the transformative potential of these digital assets. Conclusion. The enactment of the Genius Act signifies a monumental shift in how stablecoins are regulated in the United States. With its comprehensive provisions aimed at consumer protection, financial stability, and regulatory clarity, the Act not only positions U.S. dollar stablecoins as major players in the global currency landscape but also sets a precedent for future regulatory frameworks worldwide. As the digital currency landscape continues to evolve, the implications of the Genius Act will likely resonate through various aspects of the economy, shaping the future of finance in the digital age. The Guiding and Establishing National Innovation for U.S. Stablecoins Act. Genius Act, signed into law on July 18, 2025, represents a significant regulatory framework for stablecoins in the United States, creating a structured approach for their issuance and operation. The Act addresses critical aspects such as consumer protection, financial stability, and anti-money laundering compliance, while also fostering a competitive landscape for U.S. stablecoin issuers against foreign counterparts. Counterintuitive insights. 1. Consumer protection versus market disruption. While the Genius Act aims to enhance consumer protection by requiring stablecoins to be backed by high-quality reserve assets like cash and U.S. Treasuries, critics argue that this could inadvertently destabilize financial markets. If a large number of stablecoin holders attempt to redeem their assets simultaneously, the necessity for issuers to liquidate treasuries could create downward pressure on those markets. This raises the counterintuitive notion that measures intended for stability could lead to instability if not carefully managed. 2. Bipartisan agreement on regulation. The passage of the Genius Act with significant bipartisan support, 68-30 in the Senate and 308-122 in the House, is striking. Traditionally, regulatory measures in the financial sector can be contentious, often resulting in polarized views. The overwhelming bipartisan consensus highlights a shared recognition of the urgent need for regulation in the rapidly evolving digital asset space, suggesting that even in a divided political climate there exists a unified concern about the implications of unregulated digital currencies. 3. Regulatory duality. The Act establishes a dual regulatory pathway for stablecoin issuers, allowing both federal and state-level oversight. This could be seen as a move towards encouraging innovation while ensuring compliance with federal standards. However, it also creates a complex regulatory environment that may confuse potential issuers about which path to take. This duality contradicts the typical drive towards simplicity in regulatory frameworks, suggesting that a more convoluted approach might be necessary to balance local flexibility with overarching federal control. 4. Impact on foreign issuers. The Genius Act includes stipulations that foreign stablecoin issuers must comply with U.S. regulations to operate within the country. This could be seen as a protectionist measure that fortifies U.S. market share in the global stablecoin ecosystem. However, it also risks stifling competition and innovation by making entry for foreign entities more challenging, which could counteract the intended goal of fostering a vibrant and competitive market. 5. Stablecoin as a mainstream financial tool. The Act positions stablecoins not merely as speculative assets but as viable financial instruments for mainstream commerce and payments. This shift in perception is counterintuitive to the initial view of stablecoins as tools primarily for traders and crypto enthusiasts. The realization that stablecoins could serve as integral components of corporate finance, cross-border transactions, and everyday payment systems suggests a broader acceptance and reliance on digital currencies than previously anticipated. 6. Treasury holdings and potential market influence. Analysts predict that stablecoin reserves in U.S. Treasuries could reach $3.7 trillion by 2030. Making stablecoin issuers potentially the largest holders of U.S. debt. This presents a paradox where entities primarily focused on facilitating digital payments could inadvertently wield substantial influence over traditional fiscal policy. The expectation that stablecoins could reshape the structure of U.S. Treasury markets underscores the potential for digital innovation to disrupt established financial norms in unexpected ways. 7. The role of major corporations. Major companies like Amazon and Walmart exploring their own stablecoins is another counterintuitive aspect. These corporations traditionally focused on retail and logistics are now considering the issuance of digital currencies to streamline payments and enhance customer engagement. This indicates a shift in the corporate landscape where large non-financial entities seek to enter the financial services realm, challenging the long-held notion that stablecoin issuance is solely the domain of financial institutions. 8. Interest rate restrictions. The prohibition against permitted payment stablecoin issuers offering interest or yield on stablecoins is intended to prevent them from being classified as securities. This regulation seems to limit potential innovation in how stablecoins could be used as investment vehicles. The counterintuitive aspect is that by restricting issuers from providing yield, the Act could limit the broader adoption and utility of stablecoins as potential users may seek alternatives that offer returns. 9. Decentralized finance exemptions. The Genius Act explicitly excludes decentralized protocols from being categorized as digital asset service providers, which may seem to promote innovation in decentralized finance DeFi. However, this creates a regulatory gap that could lead to risks in consumer protection and market integrity, challenging the notion that all participants in the digital asset ecosystem should be held to similar standards. 10. The shift from hype to utility. The increasing use of stablecoins for practical applications such as settling B2B invoices and facilitating real-time refunds signifies a substantial shift from speculation to utility. This counterintuitive transformation highlights the evolving role of stablecoins within the financial ecosystem, suggesting that their value may not lie solely in their ability to serve as trading vehicles but also as fundamental tools for conducting business. Conclusion. The Genius Act's introduction marks a critical juncture in the regulatory landscape for stablecoins, balancing the need for consumer protection with the imperatives of financial stability and innovation. The counterintuitive insights derived from its provisions reveal complexities and unforeseen consequences that could shape the future of digital currencies in both the U.S. and global markets. As the framework takes effect, ongoing assessments of its implications will be essential to navigate the evolving relationship between traditional financial systems and emerging digital finance. The guiding and establishing national innovation for U.S. Stablecoins Act. Genius Act has introduced a significant change in how stablecoins are regulated in the United States. While many have focused on the primary provisions, several important aspects may be overlooked. Below I will highlight these often neglected points and explain their significance. 1. Impact on the Treasury market. A critical but often overlooked aspect of the Genius Act is its potential impact on the U.S. Treasury market. The requirement that stablecoins be backed by high-quality liquid assets, primarily U.S. Treasuries, could lead to a significant increase in demand for these securities. Analysts predict that stablecoin holdings in U.S. Treasuries could reach $3.7 trillion by 2030. This growth could shift the dynamics of the Treasury market itself, especially during periods of rapid redemption. Significance: this shift could have profound implications for U.S. fiscal policy and the overall economy. If stablecoin issuers liquidate large amounts of treasuries quickly, it could lead to downward pressure on treasury prices, impacting borrowing costs for the government and potentially leading to broader financial instability. Thus, understanding the interplay between stablecoin regulation and treasury market dynamics is critical for policymakers and investors alike. 2. Consumer protection mechanisms. While the Genius Act emphasizes consumer protection, the specifics of these protections may not receive the attention they deserve. The Act mandates that payment stablecoin issuers must maintain reserves on a 1:1 basis with outstanding stablecoins and disclose reserve holdings regularly. However, the implications of these requirements extend beyond mere compliance. They represent a shift towards greater transparency and accountability in the digital assets space. Significance: the Act not only protects consumers by ensuring stablecoins are backed by safe assets but also enhances trust in the financial system. This is vital as stablecoins are increasingly used for everyday transactions. A lack of consumer confidence could undermine the adoption of stablecoins, which are seen as vital for the future of digital payments. 3. Dual regulatory framework. The Genius Act allows for both federal and state regulatory pathways for stablecoin issuers. This dual approach aims to balance the need for robust federal oversight with the flexibility of state regulations. However, the complexities involved in navigating these regulatory frameworks can be significant. Significance: this aspect of the Act highlights the potential for regulatory arbitrage, where issuers might seek to exploit differences between state and federal regulations. However, it also opens the door for states to innovate and adapt their regulatory approaches to better fit their unique economic landscapes. The effectiveness of this balance will be crucial in shaping the competitive landscape of stablecoin issuers. 4. Exclusion of non-financial companies. One of the Act's notable restrictions is the prohibition against non-financial companies issuing payment stablecoins without unanimous approval from the Stablecoin Certification Review Committee (SCRC). This restriction is rooted in the historical concern of separating banking and commerce, and while it may seem like a straightforward regulatory measure, its implications are profound. Significance: by limiting the ability of large non-financial corporations to issue stablecoins, the Act prevents potential conflicts of interest and market distortions that could arise from a commercial entity having too much influence over financial transactions. This decision safeguards the integrity of the financial system but may also limit innovation from tech giants looking to enter the financial space. 5. Interoperability standards. The Genius Act calls for the establishment of interoperability standards for payment stablecoin issuers. This provision aims to ensure that different stablecoin systems can work together seamlessly, promoting efficiency and enhancing the user experience. Significance: while often discussed in terms of technical feasibility, the implications of interoperability extend to market competition and consumer choice. By fostering an environment where various stablecoins can interact, the Act encourages innovation and could lead to the emergence of a more diverse ecosystem of digital payment solutions. This could be pivotal for the long-term acceptance and growth of stablecoins in everyday transactions. 6. International compliance for foreign issuers. The Act requires foreign issuers wishing to operate in the U.S. market to comply with U.S. anti-money laundering (AML) and sanctions regulations. This provision aims to level the playing field between U.S. and foreign issuers, ensuring that both are subject to similar oversight. Significance: this requirement not only protects U.S. consumers but also enhances national security by preventing illicit activities. However, it may deter some foreign issuers from entering the U.S. market due to the added regulatory burden. The balancing act between fostering international competition and protecting domestic interests will be a significant challenge moving forward. 7. Evolving role of custodians. The Genius Act outlines specific requirements for custodians of stablecoin reserves which necessitate a high level of regulatory oversight. Custodians must be subject to supervision by primary federal regulators and they are prohibited from commingling customer assets. Significance: this provision could reshape the custodial landscape for digital assets. As traditional financial institutions engage more with digital assets, this will likely lead to the emergence of new custodial solutions tailored for stablecoins. Enhancing security and compliance. The evolution of custodial services will be a key factor in the broader acceptance of stablecoins as a legitimate payment method. 8. Bankruptcy protections for stablecoin holders. The Act includes provisions that prioritize the claims of stablecoin holders in bankruptcy proceedings. This legal framework is designed to protect consumers' interests in the event of an issuer's insolvency. Significance: the inclusion of bankruptcy protections is a significant step toward establishing stablecoins as a legitimate financial instrument. By ensuring that consumers have priority claims, the Act enhances trust in stablecoin issuers, which could facilitate increased adoption and usage. This legal recognition also underscores the importance of stablecoins in the evolving financial landscape. Conclusion: the Genius Act marks a transformative moment in the regulation of stablecoins with broad implications for the future of digital finance. While the key provisions are widely discussed, the nuances and potential consequences of these regulations may not be fully appreciated. Understanding these overlooked aspects is crucial for stakeholders from consumers to regulators as they navigate the rapidly evolving landscape of digital currencies. As stablecoins become more integrated into mainstream finance, the effectiveness of the Genius Act in achieving its goals will be closely observed, shaping the future of payments and financial systems worldwide. The guiding and establishing national innovation for U.S. Stablecoins Act. Genius Act represents a significant legislative milestone in the realm of digital finance, particularly concerning stablecoins. Here are the 4 most valuable points for in-depth analysis and discussion regarding the implications of this act on global currency norms. 1. Comprehensive regulatory framework. The Genius Act establishes a robust regulatory framework for the issuance of payment stablecoins in the U.S. This framework includes strict requirements for permitted payment stablecoin issuers, mandating that they maintain high-quality reserve assets on a 1:1 basis with outstanding stablecoins. This regulation aims to boost consumer confidence and financial stability by preventing the issuance of unstable or risky stablecoins that could lead to market disruptions. As stablecoins have processed $33 trillion in transactions, surpassing traditional payment methods, the need for oversight is paramount. However, critics have raised concerns about the potential for rapid redemptions of stablecoins to disrupt the treasury market if too many stablecoins are backed by U.S. treasuries. 2. Consumer protection and financial stability. The Act incorporates significant consumer protection measures which are essential given the rapid adoption of stablecoins as a payment method. The requirement for regular disclosures about reserve holdings aims to prevent the risks associated with non-transparent operations in the stablecoin market. By instituting these regulations, the Genius Act not only prioritizes user safety but also seeks to enhance the overall stability of the financial system. The potential for stablecoins to hold as much as $3.7 trillion in U.S. Treasuries by 2030 underscores the Act's role in shaping the dynamics of both digital and traditional finance. 3. Anti-money laundering (AML) and sanctions compliance. The Genius Act includes provisions that align U.S. and foreign issuers with AML and sanctions compliance, ensuring that all entities operating within the U.S. market adhere to the same stringent regulations. This is particularly critical in preventing illicit activities within the burgeoning stablecoin market. By leveling the playing field, The Act aims to protect national security and reduce the risk associated with foreign entities potentially bypassing U.S. regulations. The inclusion of these compliance measures reflects a broader trend of increasing regulatory scrutiny on digital assets and highlights the importance of maintaining financial integrity in a digitized economy. 4. Dual regulatory pathways and innovation encouragement. The Genius Act introduces a dual regulatory framework allowing for both federal and state-level oversight of stablecoin issuers. This structure is designed to prevent regulatory arbitrage while fostering innovation within the industry. By permitting state-level regulators to certify that their frameworks align with federal standards, the Act encourages states to create competitive localized regulations that can adapt to the fast-evolving digital asset landscape. This flexibility is crucial for encouraging innovation among U.S. issuers, especially as major companies like Amazon and Walmart explore developing their own stablecoins. The potential for state regulators to collaborate with federal agencies further strengthens the regulatory ecosystem, ensuring that it can respond effectively to new developments in the digital finance space. Conclusion. The Genius Act represents a landmark step in the regulation of stablecoins with implications that resonate far beyond U.S. borders. By creating a comprehensive regulatory framework that emphasizes consumer protection, financial stability, and compliance, the Act positions the U.S. to maintain its dominance in the global financial system while fostering innovation in digital payments. The introduction of dual regulatory pathways not only enhances flexibility and responsiveness but also encourages the integration of stablecoins into mainstream commerce. As the global landscape adapts to these changes, the Genius Act will undoubtedly play a pivotal role in shaping the future of digital currencies. Here are 3 famous historical cases that reflect significant regulatory changes or innovations that challenged existing norms in financial systems, akin to the implications of the Genius Act regarding stablecoins. 1. The Glass-Steagall Act of 1933. The Glass-Steagall Act was enacted in response to the 1929 stock market crash and the Great Depression. It established a regulatory framework that separated commercial banking from investment banking in the United States. This act aimed to restore public confidence in the banking system by preventing banks from engaging in speculative investments. It prohibited banks from using deposits for underwriting securities and created the Federal Deposit Insurance Corporation (FDIC) to insure deposits. This landmark regulation fundamentally reshaped the financial landscape by ensuring consumer protection and maintaining financial stability. Akin to how the Genius Act seeks to regulate stablecoins to safeguard consumers and stabilize the financial system. 2. The Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010. The Dodd-Frank Act was introduced in the wake of the 2008 financial crisis, aiming to prevent a similar occurrence in the future. It established comprehensive regulations for financial institutions, including the creation of the Consumer Financial Protection Bureau (CFPB) and new rules for derivatives trading. The act sought to increase transparency, reduce risks in the financial system, and protect consumers. Like the Genius Act, which establishes a regulatory framework for stablecoins, Dodd-Frank introduced a structure to oversee and mitigate risks within the financial sector, ensuring that entities operate within a safe and sound environment. 3. The Basel Accords. The Basel Accords, developed by the Basel Committee on Banking Supervision, are international banking regulations that set standards for capital adequacy, stress testing, and market liquidity risk. The first Accord, Basel I, was introduced in 1988, with subsequent revisions Basel II and Basel III expanding the scope and requirements for banks globally. These accords were designed to enhance the stability of the international financial system by ensuring that banks hold sufficient capital reserves to cover their risks. The introduction of these regulatory frameworks parallels the Genius Act's aim to create a secure and stable environment for the emerging stablecoin market, ensuring that issuers maintain adequate reserves and comply with rigorous standards. These cases illustrate how regulatory frameworks were established or revised in response to financial crises or market innovations, similar to the motivations behind the Genius Act's creation of a comprehensive regulatory structure for stablecoins. The guiding and establishing national innovation for U.S. Stablecoins Act, Genius Act, enacted on July 18, 2025, marks a significant milestone in the regulatory landscape for stablecoins in the United States. As the world increasingly embraces digital currencies, the Genius Act outlines a comprehensive framework that could reshape the financial sector, consumer transactions, and the international standing of the U.S. dollar. Below are key predictions regarding the future of stablecoins and their impact on global currency norms. Predictions for the future of stablecoins. 1. Dominance of U.S. dollar-backed stablecoins. The Genius Act will likely solidify the status of U.S. dollar-backed stablecoins as the dominant form of digital currency in global markets. With requirements for issuers to maintain high-quality reserves and adhere to strict regulatory standards, U.S.-based stablecoins may gain the trust of consumers and businesses alike. Analysts predict that stablecoin holdings in U.S. Treasuries could balloon to approximately $3.7 trillion by 2030, positioning these digital assets as major players in the financial ecosystem. 2. Increased participation from major corporations. Following the enactment of the Genius Act, major corporations, particularly in retail and finance, are expected to explore or launch their own stablecoins. Companies like Amazon and Walmart are poised to leverage stablecoins to streamline transactions, reduce payment processing costs, and enhance customer loyalty programs. This trend will not only drive adoption but also encourage innovation in payment systems, creating a new standard for consumer interactions. 3. Global regulatory impact. The Genius Act is likely to influence global stablecoin regulations as other countries observe the U.S. approach. The requirement for foreign issuers to comply with similar regulations could establish a new benchmark for international standards. As global regulators align on best practices, this could lead to more robust frameworks that prioritize consumer protection and financial stability, potentially reshaping the international financial landscape. 4. Enhanced financial inclusion. As stablecoins become more integrated into everyday commerce, their accessibility could promote financial inclusion, particularly for unbanked populations. The speed and low cost of stablecoin transactions can facilitate remittances and provide a viable alternative for those lacking access to traditional banking services. This trend will likely encourage governments and NGOs to explore partnerships with stablecoin issuers to enhance economic participation. 5. Programmable money and smart contracts. The rise of stablecoins will pave the way for the broader adoption of programmable money and smart contracts. As businesses recognize the potential for automation and efficiency in transactions, we may see innovative use cases emerge, such as real-time refunds, automated loyalty rewards, and decentralized financial services. This could lead to a shift in how businesses manage customer relationships and operational processes, enhancing overall efficiency. 6. Volatility management and risk mitigation. As stablecoins mature, there will likely be advancements in volatility management mechanisms. Innovations such as algorithmic stabilization techniques and diversified reserve strategies could emerge to address concerns about reliance on a single asset, such as U.S. Treasuries. This will enhance the resilience of stablecoins and build confidence among users, further entrenching their role in the financial ecosystem. 7. Integration with traditional financial systems. The Genius Act will facilitate greater integration of stablecoins within traditional financial systems, leading to a hybrid model where digital and fiat currencies coexist. Financial institutions will increasingly adopt stablecoins for settlements and cross-border transactions, resulting in a more streamlined and efficient financial infrastructure. 8. Impact on monetary policy. With the increasing use of stablecoins, central banks may need to adapt their monetary policy frameworks to account for the influence of digital currencies on money supply and liquidity. The potential for stablecoins to act as an alternative to cash could prompt discussions around central bank digital currencies (CBDCs) as governments seek to maintain control over monetary systems while embracing technological advancements. Conclusion: the enactment of the Genius Act signals a transformative era for stablecoins and their integration into the global financial system. As these digital assets gain traction, they will reshape payment systems, enhance financial inclusion, and redefine the regulatory landscape. The future of stablecoins is poised for significant evolution, reflecting a broader trend toward digitalization in finance and commerce with implications for businesses, consumers, and governments worldwide. The coming years will be crucial in determining how this landscape develops as stakeholders navigate the opportunities and challenges presented by this innovation.